So ni aje bro, so kuna hii stuff tulikuwa tumesema tutaangalia, so which you can see my app yangu iko down but I think it will work out. So I think I'm going to 1 hour, then I will show you the pairs that I'm going splitting, or the pairs that I analyzed and what I'm expecting to happen when the market opens up to on Monday. So this is this pair that we call uh, so this is GPP JPY. Here you can see here. So as I was telling you, when nilikuwa nakwambia, this is how I analyze the market. As you can see, so I use what we call the top-down analysis. And so since I'm an intraday trader, I don't have to start all the way from weekly or all those stuff. That one is giving me too much history that I don't need, since I just want to get in and get out within a day. So I don't have to look at the weekly. So if I have to look at the weekly, maybe I will look for the direction bias. So I want to know if the market is in a downtrend or it's in a uptrend. But I don't use weekly time frame to analyze the market. So when I go to the daily time frame, I just want to show you what I saw. So as you can see here, initially market was forming the higher highs, higher lows, higher highs, uh, higher low. This is not the higher high, since the market yet did not close above the previous higher high. So this is not a break of structure. So break of structure actually happens here. So the market was forming higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low. So this was the last higher high, higher low that was meant. This one, that higher high, market was in a pullback here till that point. So after that, now we go to what we call the market structure shift. You can see here. So this is what I call the market structure shift. Let me just label it like that. So that is a change of character. So after that change of character, now I know the market now is in a downtrend. So the market is trading down. Now, so after the market made this higher high, then you have the lower low here. So this is the last lower low. So you can see how we have a very large wick, meaning now this deep downtrend, or this kind of movement down, this momentum is dead. So now the market was in a pullback. So sorry. So here I know the market was in a pullback. Market here was in a pullback. Now the question is, where do you think the market will pull back up to? So from the previous class that we had, I told you market normally goes for a pullback at least at the 50% of the move. So we use what we call the Fib retracement, this tool. We call it the Fibonacci tool. So I click that one, I place it from the top here all the way to the bottom here. Now you can see, so the market retraced the above 50%, which is the premium. From the last previous class I told you, above 50%, it's what you call the premium. That is the premium. And below 50% down here, this is what we call the discount. That is the discount. Let me use a different color for this. Now, what happens with the premium and the the discount. So this is what happens. So now we want to sell when the price is at the premium. The premium inamaanisha, even this is just a logic, eh? When do you need to sell? For example, tuseme ni kama tu ile season ya ndengu. When do you want to sell your ndengu? Obviously, we want to sell our commodities when the price is high, and when we want to buy when the price is low. So now, since I want to sell, now the market has shifted the structure to downtrend. I expect to sell at the premium. So when the price is at the discount, I have no business here. So I'm just waiting. This is just a waiting game until the price trades above the 50%. Now, we don't just assume the price will reverse at the 50%. Where exactly above the 50% do you think the price will react from? Now, as you can see here, we have the fair value gap. This is a fair value gap perfectly that lies there. That is what we call a fair value gap. The gap between the first candle and the third candle. The wicks of those candles, they are not meeting, yeah? Or they are not joined. There is a gap there. So that means that is an imbalance. But just fair value gap alone is not enough. So I need to mark my supply. Since I want to sell, this will be a supply. When you are selling, we mark what you call the supply. But when you are buying, we mark what you call demand. So that is a point that you should note. When you are selling, we sell from supply. Maybe I can write here. When you sell from a supply area. When you want to buy, we buy from demand. Buy from a demand area. Another one, let me call it a demand zone. So that is the difference. We buy at supply, we sell at supply, we buy at demand. So a symbol is that. Now, now the question is, what is my demand here? What is my supply? I mark all the supplies within the premium. So we have this supply here. That is my supply. I call that one my supply since it is at the premium. We also have, remember, for me to mark a supply, there must be a, a fair value gap. So there is this fair value gap here. So that means whatever it's above there, that one, that buy before the sell. So that is another supply area. Now, there is hakuna supply ingine hapa juu since there is no any other fair value gap. So those are the two supply areas that I will be watching. Now, you can see here, yeah, that is our supply area. So now the next thing is it will be just be waiting game. You just watch and to see what the price is doing when it reaches your supply. And sometimes market, the first touch, sometimes it will be an inducement. An inducement inamaanisha wale the kind of traders who just want to trade ama market itakuchocha like it wants to sell immediately. You can see this big candle. Then what happens then? Market edge to induce that low, that high. Inamaanisha there are some uh, orders that were at this point. There are those people who started the selling at this point. No, the importance of waiting for a confirmation. Market did not give you a confirmation, but here you can see after it has touched your supply area, it induced some traders, the early sellers. Then what happened then? It went back to our demand area to mitigate it. What it means by mitigation inamaanisha once the price trades to your to your marked zones. Now we say that area is mitigated. So put that point down. When the market goes back to your point of interest, we say the market has mitigated that zone. Say, let me show you here. I don't want that, I want this one. So now you can say this area is gated. That means it will no longer now be my point of interest again. So in case this zone of mine fails, now I will not look at this zone again since it is mitigated. Mitigated means it is no longer a point of interest for me. Now I will look for the next supply zone or the next point of interest. But now since this the supply zone of mine uh, seems to be working, now the other one, it will remain there. I will until maybe if the price breaks this low here, if the price trades and takes out this low here, that means now this supply zone of mine it will be invalid. So I will look for the next supply zone. But for the sake of this video, let me just use this supply zone since it is the one that it's pushing the price down. Now this is what I saw. Remember, I'm just analyzing the market. You analyze the market from there. That's why it is called the top-down analysis. So this is what we call uh, top-down analysis. Top-down analysis means you are coming from the higher time frame, going back to the lower time frame. So let me show you that. You are coming from the higher time frame, going back to the lower time frame. Let me show you that. I have an arrow here to show you what I'm talking about. These arrows. I just want to show you the direction of what I'm talking about. Yeah. So you are coming from the higher time frame, going where? Going to the lower time frame. I like this one. Okay. So we come from the higher time frame, going down to what? The lower time frame. So this is what you are calling the top-down analysis. So we analyze the market from the higher time frame, going down to the lower time frame for us to get the confirmation before entering any trade. I don't just take any trade. We just wait for the confirmation. So later on, I will explain to you what are those confirmations that I'm talking about. Now, you know how to mark the supply zone and the demand zone. Whenever you see these bumps, we call this one bumps in the road. These are the bumps in the road. We have some consolidation, then extension. Consolidation, then extension. So those consolidation, now those are what we call the demand area because now it is at this area, not demand, since we are selling this as supply. So why are we marking this point as our supply area and not maybe this one or maybe this candle here? Since you can see there was a fight here between the bulls and the bears. The bears are the sellers, the bulls are the buyers. You can see some bulls here or some buyers who are trying to interfere with this momentum. They were trying to buy at this point. There are some orders that were placed at this point. But now since the sellers, they are in control of the market, guys. These sellers are in control of the market. That's you can see. They have so much momentum. If you try to look at this momentum here, how many buy candles you can see? Only one, two, these two doji candles here. So that this is to mean these are continuous the sell candles, meaning the bears are in control of the market. So those bumps in the road, those are the areas that we call, those are the points of interest. You can see here, bumps in the road, then extension. Bumps in the road, then you have some extension. Yeah, those are happens every time. Consolidation, extension. Some consolidation here, extension. Some consolidation, extension. So those things happen all the time. And those are what we call the points of interest. But we don't just mark any point of interest. So we have to consider. That's why I did not mark down here. So for example, now if I want to sell this market, I have to mark the point of interest above the 50%, which is the premium. And if I want to buy, remember I said you buy at the discount, you sell at the premium. It is only when the price comes to the premium that is when I will look for a sell. Are you getting? It is only when the market is at the discount when I will only look for the buys. You buy when the price is at low prices, and you sell. You wanna sell when the price is when the price of your commodity is high. So that is the point here. Now, remember I'm doing my top-down analysis. I just want to see from the big picture, what is happening. Because when I just jump to the 15 or 1 minute time frame, I will not understand what is happening. But now if I'm coming from the daily time frame going down, now I understand. I get the picture. What is the market doing? As I know now, now I know when I come to the market, I will only be looking for an opportunity to sell since the daily time frame is selling. Now, after the price came back to my point of interest, you can see this is the last break of structure to the upside, the higher high, higher low, then higher high. You can see here there was a change of character at this point. That is a change of character. Because this was a pullback, market was an uptrend. The reason why this market was in uptrend is to go to my point of interest, to activate my some orders, then now it will continue selling. Remember, the higher time frame uh, determines what happens in the lower time frame. Now the market has shifted down to downtrend. I can see there is a change of character. We have a break of structure down here. So this is not a valid break of structure. The valid break of structure happens here because this is the last lower low that printed the lower high here. Now that lower high here is the one that went ahead and broke structure here. Now that I know the pullback has ended now. The pullback is the one that is in uptrend. It has ended after the market changed the structure here, or the change since there was a change of character. Now I have a break of structure here. Now I know the market has broken the structure. Now this happens all the time. After the market changed the character here, it had to pull back to the premium to activate some orders now to continue down. So there was a lot of orders that were activated at this point that led the market to go all down to this point to break the structure at this point. Now, what do I know when I see that? Now I know after the market has traded down here, it has to trade back to at least 50% of this leg. That is from up here, this higher low to this lower low down there. Now, as usual, I'll pick my Fibonacci tool. After picking my tool, Fibonacci tool, I place it from top here all the way down here. Now I expect the price to trade at least the 50% of my leg. And you can see here, the price traded to the 50%. But now, after trading to that 50%, you can see the price did not break the structure here down. Why do you think the price did not go down and break this structure? Now it comes now to my very interesting part, which is called the liquidity. We have the liquidity. Where is the liquidity line? Where is the liquidity? You can see here, let me remove this line first. You can see here, there is two relative equal highs. That is liquidity, my friend. This high here did not take this high. So inamaanisha there is liquidity lying on top there, and that is what I call the equal highs. That is liquidity. So I know now the price has to come sweep that liquidity to get momentum now before going down. That is one of the liquidity, the equal highs, two equal highs. Still, there is another liquidity here. This I here is also, that is also liquidity. Remember, I'm still in the daily time frame. I have not shifted to any other time frame. So I know there is liquidity to be swept here, and there is also liquidity to be swept here. And there is my extreme supply zone on top here. There is extreme supply zone on top. Remember, why did I mark this supply zone? Because you can see here, the buyers were trying to get in the market, but the sellers took control of the buyers. So that leading to a formation of fair value gap. There is a gap in between. So this is my valid supply zone. So I'm anticipating that the price has to come back to my supply zone before going down to break this low here. Now this low down here, that low here is what I call my targeted low. That is my targeted low. So, but before the market comes down to break the structure here, it has to come down up here, and then to activate more orders now to go down to this one. So that means maybe for the whole of next week, I'll be trading uptrend. I will be in an uptrend, but I know at the back of my mind that the market is in a downtrend. But now I can counter trend. Counter trend means to go against the trend, and you can see the trend here. Uh it's a downtrend, of which this is not something that I advise the beginners to do. But for me, I have some knowledge with the market, so I can try to do uh, the counter trend. Now, if the market decides to violate my supply zone, now I know the market will it's coming to this extreme supply zone here of mine. This supply zone of mine is also valid since it's not mitigated. So if the market decides to violate my supply zone, it means it will come to this supply zone here before now continuing going down, before continuing going down. Now, this is a game of waiting. Okay, so if I go down to 4 hour time frame, if I go down to 4 hour time frame, let me first remove these lines on my chart. Session. Now I am in a 4 hour time frame. Remember, when you go down time frames, you get the zoomed function of the higher time frame. In other words, this is what we call the fractal structure. We have the structure that is in the higher time frame. The clear one is in the higher time frame. So when you go down to the lower time frame, we get what you call a fractal structure. In other words, it is the zoomed version of the higher time frame. Now, what can you see? You can see the two relative equal highs that we marked on the daily time frame. You can see now, you can see my supply zone very well. Buyers were trying to get in, but they were overtaken by the supply. So the sellers. So this is a valid supply zone. We have the liquidity high there. We have two equal highs there, which I can also extend to this point, and that one will be what we call a trend line liquidity. So during our early session, I was trying to explain the types of liquidity. By the way, let me show you down here. These are what we call the types of liquidity. So I will explain that one by drawing. So we have these equal highs here. We also have these equal lows here. Mhm. We have that kind of liquidity. So this line here, there is liquidity above and there is also liquidity down here. So this is what we call arranging liquidity. We have the arranging liquidity. That means there is liquidity below here and there is liquidity on top here. So this is when the market is in a consolidation. When you say the market is that, you remember market moves in three ways. There is an uptrend, there is a downtrend, and there is a consolidation or what we call arranging. So the market is bouncing at this support here and it is bouncing down to this resistance. There is a resistance and there is support. Support is on top, resistance down here. So this is one of the types of liquidity. So you have another liquidity which we call the equal highs, something like this. Sorry, let me delete this one and draw again. We have that. We have this is what we call liquidity. So this is equal for highs, the equal highs and maybe the equal lows. These are the equal highs. Sometimes we laugh the equal lows when we are in a downtrend. Uptrend, we have the equal highs. The downtrend will get the equal lows. So that is a liquidity. We have another type of liquidity, what we call the trend line liquidity. So maybe we are in an uptrend, something like this, something like that. So now, this is what we call a trend line liquidity. There are those areas that the market is bouncing. So this is also liquidity, and this is what we call, sorry, this is what we call trend line liquidity. Trend line liquidity. So these are the three main types of liquidity. We have arranging liquidity, we have the equal highs liquidity, and we also have a trend line liquidity. So I can see the my laptop is complaining doesn't have the enough charge. So I will wish to stop at this point. So try to watch the video once again for you to get enough knowledge. Since it's a recording, you can watch multiple times. So immediately I charge my laptop, I'll continue from there. So first digest that one, we'll continue from there. So thank you. See you in the next video. So share.